Not all debts are equal. If I say that a lot, it's because it's really important. There are other trainers out there that say just pay off all your debt. I don't agree with that. There's good debt and bad debt. There's positive leverage and negative leverage. Consumer debt generally is negative. So what do we do to maintain? I mean, basically there are best practices. Obviously, paying all of our recurring expenses on time and putting those on a credit card would be my first choice, as we've talked about, but it could also go on a debit card. That's okay too. But automate all those payments so that you don't have to remember to make the payment. You don't have to depend on, anything really. They're just automatically done. All you have to do is make sure that your credit card balance has enough room in it, and hopefully you're getting that credit card balance down to zero, because there's no reason to be paying 2% a month for anything. So you want to get that down to zero. But then you put your expenses on it and they're covered, because so let's just say you have a $5,000 credit limit and all your monthly bills add up to $1,500 that you put on a card. They're going to get paid, as opposed to a checking account where sure they'll get paid as long as you put the $1,500 in the bank. With the credit card, they get paid. And then when you can, sometime before the billing cycle's over, you come along and just pay the thing down to zero. You paid zero interest for that. It all works out. The exceptions, as we've talked about, are loans. By regulation, they cannot collect a loan payment on a credit card without some serious exceptions. So anything like your mortgage payment, that's going to have to go, or car payment is going to have to go on a debit. But any way you do it, make sure that it's automated, and all you have to do at that point is oversee it. That card, as I've mentioned, you should pay it off every month. Whatever's going on, it should get paid off every month. And if you've got a high balance on it right now, it may not be practical or possible to just pay it off, right? It's a chunk of money. Then in that case, what you do is you just make sure that every month that balance is coming down by a little bit. You choose the amount. Obviously, the quicker you do it, the better, because these days it's not 18% anymore. These days, if you look at your credit cards, they're probably at 24%. If you've got a bunch of cards, they have the snowball method, which it's interesting because you pick the smallest one and it gives you some kind of psychological rush maybe to get something paid off. But mathematically, and this is about math, most of the money problems we have are emotional, but this particular thing is all about math. Pick the one with the highest cost, the highest interest rate, and make the minimum payments on everything, put all your extra discretionary money that you're willing to put toward debt repayment onto the highest cost card you have. We definitely want to reassess our financial situation. We assessed it for how much money is coming in, how much is going out. Let's make sure we balance all that out. The next step would be to reassess those same numbers, but projecting into the future. What's my life going to look like in 5 years, in 10 years, in 20 years, if I stay on this course? And if you want to save, let's just say $100,000, it doesn't mean you have to save $1,000 a month for 100 months. Yeah, 100 months. Because money compounding works in both directions. Both when you pay your credit cards down, that's helping you. It's also compounding on the way up. So you don't necessarily need to save $1,000 a month for 100 months to have $100,000. You're going to, once you get past your emergency fund, which is just $1,000 or so to cover basic emergency that might happen. Once you get past that, you're going to start putting your money into things that actually pay you a return. That first $1,000 goes into a checking account because you need it available to you no matter where you are, no matter when it is, anything. You just need to be able to pull out your debit card and have it. The next step up out of 4, I guess, would be reserves for income replacement. And it's really reserves to maintain your lifestyle. But typical rule of thumb on that is 3 to 6 months worth, depending on the stability of your income. It's not a small number. As you start saving for reserves for replacement for your income, it may be $15,000, $20,000, $60,000, $70,000 at some point because of depending on your income. You want to make sure you're getting a return on that money. So you look at the stability of your income. Rule of thumb is 3 to 6 months. If you're self-employed, you want probably more than 6 months. If you're in business for yourself, you may want 24 months. I mean, you got to look at the stability of your income and the odds that it will continue. So yeah, create a budget, prioritize your spending, cut out the truly unnecessary expenses if you haven't done that yet. Now you want to look at your budget in terms of projecting into the future. Now that you've gotten yourself stable, you want to say, if I can stay on this path, what's my life going to look like in 5, 10, 15 years? Our brains work linearly. We do not understand exponential growth or exponential failure for that matter. So when our brains were designed for deciding whether we can run fast enough to get to that tree before the wolf that's chasing us gets to us, right? Our brains are designed for that linear kind of progression, but money works exponentially. It has a growth curve and a decline curve too, either way, because it's not based on addition, it's based on multiplication. There's nothing magic about it. There's no magic of compounding, it's just math. So when you do that budget, you obviously want to track your spending and continue tracking it, because what happens, there's two things going on here, and one of them we're good at, one of them we're not. With ADHD, we're good in a crisis at saying, oh my gosh, I got a big problem. I put it off as long as I possibly could, maybe longer. There's damage being done. We jump in and we solve the problem. But what happens is we don't maintain the problem. There's entropy in the world, right? Any system will begin to break down if you don't maintain it. And so you need to continually track the spending and just see, is it going up? Is it going down? Is it outstripping our income? Are we on track for the raises and things we thought we were going to get in our work? So first, you want to pay all your recurring bills on time. And if you can't do that, at least pay the ones that are impacting your credit, right? Because those are the ones that are going to be seen. You negotiate with the other people. Secondly, as you're paying everything on time, you want to create that emergency fund of $1,000, and it's crucial. You fall off the ladder, it costs you a lot of money. If you don't have the money to do something, that $1,000, whatever it is, may cost you $1,500. Third thing would be to evaluate your lines of credit, your revolving lines of credit. I would put 50%, and these numbers you can do what you want, but I would put 50% of my discretionary money into reducing those revolving credit lines. And I would put the other 50% into building up reserves for income replacement. Mathematically, if nothing goes wrong, you come out ahead by putting all of your discretionary money to pay the credit cards down. Makes perfect sense, but there's more than math involved here. And if something was to go wrong, and credit lines get closed through no fault of your own sometimes, it's a global economy thing. So I would err on the side of caution, because when you fall off the ladder, you do damage. So we want to be stable before we grow. So I would put 50% towards my revolving lines, get them all down to less than 70% of their maximum on an individual basis. And I would concentrate on the ones at the highest interest rate, of course. And then building up your reserves for replacement is good too. If you're at 99% credit usage or 100% or 101, I've seen, and 101 happens even though someone's paying on time, because they're right at the edge, and then the billing cycle comes on and adds $400 to their balance and pushes them over the limit, and that gets reported. But it's exponential. Every dollar you pay off your credit cards will improve it all the way down to zero. But the general idea is at least get them below 70% so you're not in crisis, and you really want to get them below 30%. It's a curve that kind of slopes off. So after you have your 3 to 6 months worth saved up, then I would accelerate paying down those revolving credit lines. And after that, I would begin working on my any installment loans I have. Revolving are like credit cards where you can pay the bill and borrow it back, pay the bill and borrow it back. Installment loans are like a car payment. So then I would, after the credit cards, which are much higher interest rate generally, I would start working on any installment loans I have. And that would be, car loans and furniture loans, whatever else you might have. A really big overlooked strategy. You can plug all the leaks you want, and you should plug the leaks, the wasted money, but it's much more pleasant to figure out how to earn a little bit more money. So that would be the next step here, is to figure out how to bring in a little bit more money, and then you can put that towards the debt if you want to, or just use it to accelerate. It's much more pleasant to make more money than to save money. And you can't, the silly mantra is you can't save your way to wealth. No matter how much you save, even up to 100%, if you're not earning much, it's not going to make you wealthy. Not that that's the goal necessarily, but if you want more money, you're going to find it on the income side more than saving. You can only do so much with savings.